friends, having been connected with the capital market way back since 1982, even much before the SEBI came in, I thought, let me share my experiences with you all about how to evaluate an IPO, initial public offering. An IPO can be for two purposes. One is to raise funds for the company, maybe for its capex, working capital requirement, repayment of loans, or a mix of all. And an IPO for offering the shares held by the existing shareholders to the public for the first time. And this offering is generally made by the early stage investors, the private equity funds, and other investors who have invested in this company maybe 3 to 5 years back. Now, how do the preparation for an IPO start? A company, after having decided to come out with an initial public offering, which means to get its equity shares listed on the capital markets, on the stock exchanges, gets the approval of its board and decides to go ahead with it, it appoints a merchant banker, a SEBI registered merchant banker, to initiate the process. The merchant banker's main job is to help the company preparing an offer document known as prospectus or a red herring prospectus. This is what is a very, very important document for every investor to study. What this DRHP contains? It contains almost every information about the company, its products, its promoters, its business, details of the industry, the environment, the business environment, its shareholding pattern, the purpose or the object of the issue for which the company wants to raise the funds, and the detailed restated financial accounts of the company for last 5 years or from the date of the initiation of that company, along with the financials of its associate and the group companies. But 2 or 3 things which are very important in a draft red herring prospectus are: number 1 is the risk factors. The risk factors which the company feels are external or which the company do not have any control, and the risk factors which are attached to the company internally. The risk factors are basically drafted with the help of the merchant banker and the promoters together, the company management, whatever risk they pursue. As far as the external risks are concerned, since the management has or the company has no control on that, they do not have much significance or importance except to at least read it and to judge from it. But the internal risk factors are very important. What are the risks associated with this company? Does it have a lot of legal cases of huge magnitude? Maybe civil, business, criminal cases against it. It has a lot of claims which have not been acknowledged for. It has some risk which has been given by the auditors in their audit report. It has a risk or a threat of a competition. What kind of competition? It has a risk or threat on its product, technology, patent and copyright, or has a risk created by its labor union, labor unrest. So all kind of risk, financial, legal, civil, which and what the management and merchant banker together can think of are listed in this red herring prospectus, which gives you a very clear view of the risk which company has and which might have the impact on its working, its profitability and its growth in future. The second important is the overall details of the legal cases or the cases against the company, which is a separate section in the DRHP. And the third one, which I have already referred earlier, is that detailed analysis of the financial statement of the company. What is the growth pattern of the company? What is the EBITDA growth? What is the net profit of the company? What is the capital position? How the company has been rewarding in the past to its existing shareholders, the dividend policy of the company, and what kind of restatement the auditor of the company has done, for which the company might not have provided for in the earlier years. Is there any problem with any group or associate companies in their financials? Which is again a very important factor. Having assessed that, you have to come back on the building of the share capital of the company. At what rate the promoters issued shares to themselves? At what rate they have issued the shares to others before coming to the public? Whether there is too much of a difference between a price which is given to the public or the price at which it has been issued to the promoters or the other investors at an early stage. Is that justified? Once you do that exercise, then go to a paragraph which has the justification for the premium or pricing, or for that matter the valuation of the enterprise. Study it in detail. Compare with the peer companies which are in the listed space. And after having done the entire study and arrive at a proper valuation, give some discount for its being unlisted today as compared to a listed company. So this is how in an IPO you have to verify the DRHP and then the various kind of advertisements, the corporate advertisements which are issued by the company. If you take the proper judgment by reading the document properly, you would not make the mistakes which the people generally make based on the hearsay, based on the premium, the hype which is created by the vested interest, the number of oversubscription in the company. Nothing of that sort will impact or affect or influence your mind once you have studied the DRHP and then took the right decision. Thank you. All the best.